Hi, I really hope you enjoy this educational video. My name is Mark Byelich. I'm a certified financial planner, and my team and I focus on developing tax efficient or tax-free retirement strategies for our clients. We also focus on investment strategies that allow folks to eliminate the worry and have the potential growth that you need in retirement. So enjoy the video, and at the end, I'll tell you how you can schedule a no cost, no obligation consultation with me. Enjoy. Hello, everybody. Just fixing my camera. Good morning, everybody. It is just about 10 o'clock on Tuesday, April 13th. Hope everybody's doing well. I feel like I say it every Tuesday, but it's another beautiful day. I hope you have an opportunity to get outside, and I hope I have an opportunity to get outside. We have a very full calendar today that runs until about 8 o'clock. Tuesday's my late night, and we are certainly full every Tuesday, it seems like. So we're going to go over quite a bit today. We should be ending right at 10:30, if not before. But I just want to remind everyone that you are muted. There's a Q&A at the bottom of the screen. Chat is disabled, and this meeting is being recorded. And we're making some headway on putting the recordings up to the website. So we've got several pages created on our website and videos embedded into them. So I'm hoping in the next 30 days, you should be able to see some of our key recordings up there, our special webinars, our classes first, and then you'll see these weekly webinars after that. So hopefully you'll be able to search for things that you'll be able to find or that you're looking for, and you'll be able to get that information intra-week instead of just waiting for the live webinar. So speaking of which, we do have some upcoming special webinars, and we have the funding webinar you asked for using annuities and retirement planning and Roth conversions. That is tentatively scheduled for either April 28th or May 5th at this point, and it may be May 5th. It's just the timing with invitations and availability. But then we're going to have fiduciary assistance for powers of attorney, trustees, and executors. We went over some of that last week on the call. So we'll do a deeper dive into that. And then investment fundamentals. So it's always a good time to talk about investment fundamentals, but certainly right now, there's a bit of a shift in the markets. We're probably almost definitely at the end of a very, very long bull run, right? So constant growth in the bond markets. And we're going to talk a little bit more about that. And a lot of our efforts around portfolio development right now are focused on what we're doing to offset the risk of bonds, or manage the risk of bonds. Because many investors rely on bonds to offset risk in their portfolio. And what they may inadvertently be doing right now is exposing their portfolios to more risk. And that's one of the risks of the target date funds, because those target date funds automatically put you in a higher bond allocation. And if suddenly now we're coming out of this big run up over many, many years, it could take some time to come down or to adjust. So we're going to talk today about Beneficiary RMDs and the Secure Act, and I'm going to jump right into that before we talk about the market updates. Excuse me. So just heard on over the weekend that there is an IRS publication 590B. Just doesn't matter to you. It has to do with the Secure Act and the elimination of the stretch IRA. So this is not a positive event. So the understanding when the Secure Act eliminated stretch IRA, so we're talking about non-beneficiary or non-spouse beneficiaries of IRAs, other than eligible designated beneficiaries. So anybody who is not a spouse or is not an eligible designated beneficiary, and an eligible designated beneficiary are minor children of the account owner, disabled individuals, chronically ill, and beneficiaries not more than 10 years younger than the IRA owner. So they're the eligible designated beneficiary. So I'll say it again: surviving spouses, minor children of the account owner, disabled individuals, the chronically ill, and beneficiaries not more than 10 years younger than the IRA owner. So everybody else under the Secure Act has to withdraw the funds by the end of 10 years. So we treated it, everybody treated it as though it was like the existing 5-year rule where you didn't have to take withdrawals during that period, that 5-year period, but the account must be depleted by the end of 5 years. So over the weekend, and this is what's great about being involved in the slot group. One of the great things is that I got notification over the weekend of this publication that came out. There's a communication from Ed and one of his staff about what the implications are and what it means. So it looks now, per this publication, that you can't wait until year 10 to take all the money out of that beneficiary designated IRA, that you must take RMDs during that time. So years 1 through 9, you're going to be required to take RMDs just like you did with a stretch IRA, and then it all has to be removed in year 10. So here's the recommendation on this. This is a very new publication from the IRS. The recommendation is just to hold off doing anything right now until we get some clarity on this. And hopefully that will happen soon, because it is a big surprise. No one that I've heard of expected this outcome from this, other than maybe the IRS. But the IRS is going to rule this, right? So if we're going to be required to take those required minimum distributions during that 10-year period, we're just going to have to do it. But it is contrary to what the belief was across everyone who I talked to about it. So that's a really important update. I'm just going to pause there and see if we have any questions about that. So feel free to raise your hand or type in the Q&A. Okay, I don't see any questions. So again, just another really good example of having this timely information. Again, I received the email, I don't know if it was yesterday or over the weekend, but the publication came out on Friday. So Ed and his team read through it, identified the issues, came up with an opinion, and sent it out to us with a nice video, and of course a memo as well, a letter to us. So that's really, really helpful, and I thank Ed and his team. It's been since 2011. You've all heard me say, since Ed Slot really changed my practice and changed the way I do things, and that is just another example of the benefits of Ed and his group, is just always having updated information. So if you're listening, Ed, I know he's not, but if you're listening, Ed, I really appreciate it. So where are we? Shifting to investments. Let me just see if I have another note. No, shifting to investments. Oh, I'm not ready for investments yet. I thought we had something before that. So early, either late yesterday or early this morning, I received the Consumer Price Index report for the Mid-Atlantic region, and then New York and New Jersey came in shortly after that. But I want to share this with you. So I'm going to pull this down, and I'm going to share my screen. So this is from the Bureau of Labor Statistics, and again, you folks know that I like to share with you things that anybody can get. You can sign up for this if you're so inclined. And I'm hoping, let's see here. I think I might be sharing the wrong screen. I've been having some screen share challenges lately. So all right, raise your hand if you're seeing something that says Mid-Atlantic Information Office for me. Okay. Normally there's a green ring around the screen that's sharing, and I'm not seeing that right now. So what you have in front of you here is the report that I get on a periodic basis from the the Bureau of Labor Statistics, which shows the Consumer Price Index for all urban consumers. See the CPIU. There's a few different CPIs, but we're going to focus on the CPIU. Now you'll see that there's different areas: Philadelphia, Camden, Wilmington, Washington, Arlington, Alexandria. I hope you're following my cursor here. Baltimore, Columbia, Towson, Northeast region, South region. I'm just going to, right now, we can go to Northeast, but let's talk about the U.S. city average. So the first line here, let me see if I can mark this without it being too messy. The first section here is all items. You see that 2.6%. So that's significantly higher than we've seen in the past, but it's expected, right? We've been talking about higher inflation for some time, but we're seeing it now. But look at some of the other areas that we're seeing. Well, food and beverage is up 3.4. Well, that's a bit higher. Meat, poultry, and fish, 5.4. We're seeing that. You know, you probably know that I like to barbecue. I have a big green egg, and I do these low and slow smoke events, not events, but just I like to cook the ribs and the brisket and pulled pork, and I'm always looking for more ideas. So if you have any, let me know. But that cost of that is going to be higher for me this spring and this summer, and I'm really anxious to get started with that. So you know, we also see rents are up 2%. That's not above the norm, really. What's expected. Food or fuels and utilities. Look at this one, 4.4%. Piped gas service, 9.8%. New and used motor vehicles, 4%. Transportation is up 5%. Private transportation, 5.8% for overall transportation. Private transportation is up 7%. These are big numbers. So scrolling down a little bit, I have to clear these annotations here first. But scrolling down a bit more, you'll see really staggering numbers. Let's look at motor fuel and gasoline. We've all experienced this, right? 22% year over year. So this is from this time last year to this time this year. And then energy, 13.2%. So I'm just showing you this to bring your awareness to the risk of inflation. We've been talking about it for some time. Now we're seeing it directly from the Bureau of Labor Statistics, and it's probably just going to get worse for some time until we have some balance. We've had super low inflation for a long time. We've had a situation over the past decade plus where inflation has been low, interest rates have been low, bonds continue to increase in value, and the stock market has increased in value. It can't sustain that way. We all knew this, and we really got hit in the gut with it last year when we hit a global recession and a global pandemic. Now, what was beneficial is that we recovered from the drop in the market, right? The stock market and the bond market very, very quickly. But there are going to be shockwave effects. And the shockwave effect is higher inflation, higher risk of bond values dropping because of rising interest rates, and that's normal, but we're just not used to it, right? We're not used to it because we haven't experienced it for more than a decade. So I hope that makes sense. So let me come off of this slide, and I'm going to move away from consumer price index. So if anybody has questions before I move on, please let me know. All right, I'm going to stop my share. Okay. When you see me looking, I know I explained this before, but I just like we have a lot of new people who registered. We're up well over 100 registrations every week on this webinar, which is really fantastic and really exciting. I just want to explain that I'm not watching the TV or something like that, but I've got 3 different monitors going on, so I'm moving things around sometimes. So how about the markets for the last week? Well, I like to look at, as you know, I like to look at Invesco. Really, I talked to my eye doctor because I suddenly can't see anything. Well, the Dow Jones Industrial Average over the last week was up just about 2%. Year to date, it's at 11%. Really great. S&P 500 is up 10% for the year, 2.75% last week. The NASDAQ is up 8%. Even though NASDAQ has had a choppy time this year, it's still positive 8%. Last week was up 3.13%. And from this time last year to this time this year, the NASDAQ is up over 71.89%. Really something. Interest rates are up significantly, as we know. So the, let's see, where are my interest rates? The 10-year Treasury is currently at 1.66%. The week before that was 1.72. 1 year ago, it was, look at that, it was 0.72. So it's up 1% year over year. That's a lot. It may not seem like a lot, but that is a lot. So the rising interest rate really gives us the risk of bond values dropping. And there was one of the companies I listened to is Riverfront Investment Group. And they made they had three good takeaways from their weekly analysis. The first quarter reminds us how much bond prices can fluctuate. Bonds are not without risk. Again, a lot of investors say, I'm going to put my money into bonds as I get closer to retirement. You got these rules of thumb. If I'm 60, I should have 60% of my money into bonds. If I'm 70, it should be 70%. You can't listen to those rules of thumb because bond funds are all different. First of all, the longer duration that they have, the time that they hold their bonds, the longer duration you have or maturities, you tend to have more fluctuation. So you've got to be aware of that. Their type of bond structures, whether the interest rates or the yield you get can rise or it can fall. So there is a lot going on with bond managers. And I have to tell you that you're probably better off, and this is one of the discussions we're having about passive investment versus active investment. It may be that you're better off with an active manager if you can find one that manages bonds well during a rising interest rate environment, instead of just having that index fund that everybody loves because they're cheap and efficient, right? But if your index fund that matches your bond index is cheap and efficient, well, that efficient might just be in a downward slide. So we have to be careful about that. Riverfront thinks that yields can go higher, perhaps up to 2.2%. Sure. Talking about the 10-year treasury. And should the 10-year yields rise another 0.5%, I think this was interesting, it will take nearly 3 years of income to cover the price loss. So we get coupons or interest off of those bonds. And they're saying if it just goes up another 0.5% up to that 2.2, it'll take 3 years of those coupons or that interest to make up for the price drop. So just something to pay attention to. One of the most popular bond funds out there I have in front of me, the Invesco Core Bond Fund. We use Invesco. That's down so far this year, 2.32%. So you've got to pay attention to that. I am always concerned about these, the discussion about bonds and safety, because it can be a very, very difficult road as interest rates go up. So what's the answer to that? Well, as always, it's strong asset allocation. Start with a good foundation in your portfolio. Principal protection. This is a really good time to look at principal protection for the amount of money that you want out of the risk of the markets, including bonds. When we're using principal protected entities, CDs, fixed indexed annuities, we're often looking at that as a proxy to bond allocations. Because if you can get solid returns of 3, 3.5, 4, 5% without any principal risk, that's a really great offset to bonds. And of course, account segmentation. So remember, account segmentation is having a plan for each time in your life and the individual portfolios to fund those times in your lives. And we're, of course, defensively optimistic. We don't want to just assume that things are going to be terrible and put things all in the cash. That's not how we operate. We want to build that strong foundation and be ready for the kind of drops in the market that happen from time to time, whether the bond markets or stock markets. Because if you have that plan in place and you're using asset allocation, principal protection, and account segmentation, then just like those buildings in San Francisco that are built with the idea that there are going to be earthquakes from time to time, and while there's maybe damage to those buildings, they shouldn't crumble. It's the same situation with your portfolios. Let me see what else we have. Well, folks, that is all I have for this week. This might be a record. It is 10:18. Mark Byelich said everything he needed to say in 18 minutes. Goodness gracious. So let me just check to see if there are any questions, and if there are not. All right, I see no questions. I will see you all again on next Tuesday. I hope that was informative and helpful, even if it was short. Our upcoming special webinars are funding your retirement and doing wealth conversions using annuities, fiduciary assistance for powers of attorney, trustees, and executors, and investment fundamentals. So at the end of this webinar, as you log off, you're going to have an opportunity to schedule time with me. My April calendar is nearly full. I do have some time this week, and then at the end of the month. Just a few days. So if you want to schedule time with me, you certainly can, and we can review any questions that you have that are directly connected to your situation. So it was great seeing you all, and I'm looking forward to seeing you next Tuesday and at our upcoming special webinars. Have a great day. Thank you. Take care. Hello again. I hope you enjoyed the video and perhaps you learned something new that can help you. If you want to schedule time for me for a no cost, no obligation consultation, you can use the link in the description and schedule a time that works best for you. If my schedule is full and you can't find anything, don't worry. Send us an email and we'll find a time that works for you. I look forward to speaking with you soon. Thank you. Have a great day.